You ever heard of the term velocity of money? It refers to how fast money is moving through the economy. When we talk about M2 money, this includes cash, checking accounts, savings accounts, and other similar assets. A rise in its velocity means that people are spending more money more often to buy goods and services. This is what we are experiencing right now today. I'm going to show you what's occurring and why that is the case. Now, this is a good thing because it shows that the economy is growing and people have more money to spend. The increase in velocity can be because people are spending more, businesses are investing more, or the central bank is putting more money into circulation. Either way, when the velocity of M2 money rises, it's a positive sign for the economy because it means that more money is being used productively, which can lead to economic activity and growth. But hang on, because there's much more to it than that generic introduction. If everything was working normal, that's how it would be. But I'm going to show you a twist on this and why things are not so simple. I'm going to show you the M2 money, I'll show you the velocity, and I'll explain why this is happening right now. And this contraction in the money supply is actually so devastating. And it's a four-letter word, and it starts with D. You know what it is? Let's go. Let me show you here. We're looking at the velocity of M2 money. And you will see that over the last decades, this has been declining and declining and declining. And then it had a shocking decline in 2020. However, since then, the velocity has picked up. And what has changed since this last year or so? Well, it has been very clear that there has now been a tightening policy. And that's going, of course, with the Federal Reserve, as we're showing here, and the government in the way that there was so much stimulus before, and now they're starting to reverse that. So this is really important to see it, because it gives you a look as to what's happening in the monetary system. We pumped out a whole bunch of cash, and now we're drying up that liquidity. How long they could do this for without collapsing the system, that's a whole different story. Let me show you this. M2 money supply just dropped the most ever. Let me repeat, the most ever. What that says about the Fed's next move. You see, when you look at the actual, I'll show you the chart in just a second, but it's strange to see a change in where we have not for decades, okay? M2 money supply just experienced its largest ever year-over-year decline on record. But that doesn't mean the Fed's work is done. In fact, I'll show you here in just a second. They want to bring inflation down to 2%, and they need to increase interest rates in order to do that. They still haven't achieved that by far, but this is what they're trying to do, and as a result, they're draining money from the system. And so you could see right here, M2 money supply levels are up 39% from where they began in 2020, okay? So that little dip downward, I know on this chart it looks kind of funny, but that little dip downward is the most ever. But you look at it over, let's say, a 3-year period, okay, we are way, way up. They printed a lot of money, but it shows us that things have changed. And this system is based upon debt. It's all debt, 4-letter word. And so when we look at what's occurring here is a reversal of the trend. Printing money, reducing interest rates, quantitative easing, buying bonds and mortgage-backed securities and everything else they can do. And that really, began many years ago, but let's just take it from where we had peak rates, 1980. And ever since then, it's been declining. But now there's been a big change, hasn't there? Well, let me talk about M2 money and why this is so important. I've had many people asking in the comment section, let me know what M2 money is. I don't even know. Well, here's a quick explanation and why this is important. M2 money is a way to measure the amount of money in the economy. M2 money was rising for decades and it has suddenly dropped. It could mean that there's less money moving around in the economy. The drop could lead to some problems. For instance, economic slowdown. less money could be a sign that the economy is slowing down. This could be because people are spending less money or businesses are investing less. And we know that actually to be the case today. Harder to borrow. Less money in the economy could make it harder for businesses and individuals to borrow money, which could slow down economic growth. And we've already seen that. Businesses are getting real worried. Higher borrowing costs, if the drop in money is because the central bank is trying to slow the economy down, and we know that is the case, well, then it could lead to less investment and slower economic growth as well. So that's really what this is all about. It's showing us that when you have a system based upon debt and the expansion of the money supply, as soon as that contracts, we have a problem. I warned about this back in 2012 in my first book, where we talk about this. It's a cycle, and if you watch that cycle, you know exactly where to invest. You know exactly where to put your money. But you have a lot of misinformation that's out there that keeps you from knowing the truth. And of course, if you want to know the truth, just hit that subscribe button and I'll bring it to you every single day. In fact, I'm going to be focusing more on the financial education aspects right here and tying that in with the news. If you appreciate that, please let me know. On the other hand, Egypt's M2 money supply is up 31.6% year over year in January. And the reason I mention this is that not every single central bank is doing the same thing. We have to look at that, and then we see the effects of this. But the majors, the big boys out there, are going into a tightening cycle. That's the case. So I'm going to keep an eye on it. I'm going to see what happens as a result, okay? Car debt is piling up as more Americans owe thousands more than the vehicles are worth. Big problem. You increase the cost, certainly that's a problem. The actual car price is elevated. We see that in the CPI numbers. Although they've come down off their highs. And then you look at the borrowing costs being too high. As I just explained to you, this is one of the factors. Dealers worry record prices leading to negative equity surge, of course, but they were happy. See, this is the thing. Nobody wants slower growth for a period. They just want non-stop 20% year over year gains. I'm unwilling to accept anything else. And then what do you have? You have a big problem afterward. Instead, if they would not intervene the way they do, you would have slower growth. And when there would be, let's say recession or what have you, it would be much easier. But we go through these major cycles of up and down. A lot of pain is experienced here. So here we have it. Let me show you the next aspect. Let's break it down. We're talking about the Federal Reserve. Fed's Kashgari open to either 25 basis points or a 50 basis point hike. I think they're still going to go for that 25 basis points. That is relatively, the consensus, I would say. A lot of the more what they call hawkish individuals at the Fed are not voting members right now, conveniently. So we'll see. But anyway, they're basically just, looking at it. We need to stop that inflation. I think they're going to go for 25 basis points. That means they're not really too tough, but they're not stopping yet. So they're trying to balance that out. And here we are. They say they're going to be at 5%. Then it was 5.25%. And now, in fact, the expectations from the market, this is it. By the way, do you see these numbers that when I show you like a quote or when I show you the Fed funds rate or what have you, I literally bring you each piece of data that surrounds it so that you get that three-dimensional view of any of the stats, of any of the topics. If we're talking about inflation, I've shown you 100 different ways to look at inflation, and I'm constantly showing that on a daily basis, different pieces of that, whether it's the car market, whether it's some sort of obscure interest rate, whether it's coming from another central bank. All of that is really important. Okay, so right now the expectation is 5.45%. So almost 5.5%, where the Federal Reserve would stop increasing interest rates. Whether we'll see that remains to be seen, but that's what the market is pricing in here, or the market is expecting, I should say. Then we have this, the no landing story count versus the soft landing story count. So now what's happening is that there's been this big reversal over the last little while that we're not going to have a landing, there's not going to be a crash, and there's not going to be an issue because the Federal Reserve is going to take care of it. I don't know where that comes from exactly, but the media is willing to push that story, that's for sure. And you have the financial conditions index, which I've talked about at length before, but that's the blue line, and essentially showing us directly, by the way, directly correlated to what's happening in the markets, that as the conditions tighten, well then you have a direct response in the markets. Conditions tighten, markets decline. Conditions loosen, well then what happens? It's the same situation, okay? We gotta look at that and really just not ignore it like others do. Like this is the key. This is absolutely the key. And if you want to ignore it, for a lot of people they can and they do, and unfortunately for them, they're just missing out on the best information possible to make the right investment choices, to do things that, in my opinion, are the right thing. We need to learn the financial education. That's what this channel is all about and has been since 2011. Released the book, officially released in January of 2012, and I've been sticking true to those principles ever since. If you appreciate this video, if you want to give me some comments on this, please let me know in the comments below. I am always looking forward to hearing from you. I'll see you tomorrow. Take care.